Hi guys, so take a look at this picture. This is a picture of a water buffalo and egret. So egret is kind of a bird which eats the insect of buffalo's back. Okay, so basically the water buffalo needs these birds to eat the insects, otherwise it will have some kind of disease. And the insects also find like food on the buffalo's back in a way. So this type of a relationship is called as a symbiotic relationship. Okay, now from an economics point of view, both US and China have this type of a symbiotic relationship. Why am I saying it? So very quick fact here is that China is a net exporter. US is a net importer. They are one of the biggest trade partners in the world, where US imports a lot of stuff and China exports that stuff to the US. What does this mean in simple language? In simple language, there are two implications for this. One is that US has a great domestic market. It has high quality customers, and China, by exporting a lot of stuff to the US, makes crazy amount of money. Similarly, now US now is saying that, you know what, boss, we don't need your goods. We'll put like crazy tariffs, 104% tariff, 150% tariff, 199% tariff, or whatever it is. And then what will happen in the US? Well, what will happen in the US is that they'll have to figure out a way to manufacture the same stuff that they are currently importing from China and throw it in their economy. So China is a very low cost producer right now. For example, imagine that if we are making this pen in the US, right now it might take like US $100 to manufacture this pen. But if they are importing this from China, they can do it in probably $10. Now, therefore, there is an advantage for US based customers to buy stuff from China. To cut the long story short, what is simply happening is that there is this egret water buffalo type of a relationship going on between US and China, and they both need each other. Why did I tell you this story? A very simple point there is that this story depicts the reality of the economy in which we are living. A lot of hoopla is going on that, you know what, China is going to destroy US. Some people are saying that, you know, that Trump is now going to flex his muscle and destroy like Xi Jinping. A lot of talk is going on. The markets are reacting very violently. So on this video, I'm going to do three things. Number one, I'm going to help you understand a little bit more why US and China depend on each other. Number two, there are talks going on that this will be like a new Cold War. So the first Cold War took place between USSR, which is Soviet bloc, and US back in the day, around like 70-80 years back. And it existed and it lasted for like 4 or 5 decades. The reason was that these two are the super blocs or the giant economic powers. Now the giant economic powers are the US and China. So will this lead to like Cold War 2.0 type of a situation? Third and finally, what is it that investors should do? You will get very simple, easy to understand economics commentary. Sorry, I could not shoot like videos early. I was busy with my hedge fund work. A lot of exciting stuff happening there. So maybe I'll make a separate video on that. But if you watch this video fully, you will get a complete understanding of how to act as an investor in these troubled times. So that's my only request, that if you don't have the time now, don't watch it. Not a problem. Just watch it whenever you have time. I'm going to simplify a lot of stuff for you. Okay, so let's begin. And first and foremost, why does US and China depend on each other? It's very simple. That great, China is a low cost producer, right from holy pichkaris all the way till like, you know, even chips now, right? So they are getting better and better. Companies like BYD, right, which is a great car manufacturing company. It is kind of killing Tesla's business, one could argue, because they are able to manufacture high quality material at a fraction of a cost what US can do or any other world market can do. In fact, China is so dominant in terms of its manufacturing, right from low end manufacturing to high end manufacturing, that they are setting up satellite countries like Vietnam and Thailand and Cambodia, through which it is exporting Chinese stuff where? Primarily to the US. Okay, so for China, number one market is the US, and in terms of importing stuff for the US, China is the number one stuff. It's very easy to say that, hey, you know what, US will say that we don't need China, China will say that we don't need the US, but again, that water egret relationship is there. Both of them need each other to survive. Otherwise, their economy will go into a collapse. This is the basic fact that you should know. This reflects in numbers. Here are some numbers that are there. So here you can see that what is the net export of China to the US, and you can categorically figure out that China depends a lot on the US and US depends a lot on China. This relationship relationship is not going anywhere. So I do not wish to make this video sensational. I want you to think a little bit rationally, and you yourself will be able to figure out that people who are giving out all this doomsday scenario that, both these countries are going to kill each other, just remember this image. Okay, so this is point one. Point two is that, is this the new Cold War 2.0? The short answer is no, because if we look at the economic side of it, which is what I explain on this channel, and in case you're not a subscriber, please subscribe for economics insight. Now, in Cold War 2.0, from an economic lens, four things were there. Number one thing was that there was a global economic rise of blocks. Now, is this happening right now? Yes. So we can categorically see that there are two powerful blocks. One is US and China. So this has a similarity feature between Cold War 1.0 and Cold War 2.0. Number two, military spending. So is US and China increasing their military allocation? The short answer is no, not at all. The new war, if we have to think of US and China fighting for supremacy as a war, then the new war will be fought financially, not necessarily militarily. Okay, so this is a very important point, because whenever military spending increases by either of these countries, that's primarily a non-productive spend, right? Now, because both of them are nuclear nations, so to say, both of them are capable enough to damage each other, I don't think that they are going to escalate their military spending. Okay, so this is point two. This is a non-similarity between Cold War 1.0 and Cold War 2.0. Number three, there were economic struggles in Eastern Bloc. So for example, USSR grew to prominence, right? And then towards the end of their decline, right, after like 30-40 years of Cold War 1.0 starting, they kind of collapsed, right? So there were economic fissures in USSR. Now, do you see economic fissures in China? No, it's actually rising up. Now, what about the US? Now, do you see economic fissures? Now, many of you would say that yes, US dollar is getting de-strengthened. A lot of problems are there in the US, etc., etc. True, but if you just step back and see their stock market, for example, it's not as if that US does not control the biggest bond market or the biggest stock market. Both the markets are prominent in the US. You might expect the decline of the US economy to happen like this, but it will not happen like this. It will take decades to play out. Is US on a downward sloping curve? One could argue yes, even from an economics point of view, but the sphere of dominance in the US is massive right now. It's not going down anytime soon. So please remember this, that yes, US is on an economic decline, but that decline will pretty much take, I don't know, like 30, 40 years, 50 years, right? So maybe we don't need to worry about this for in our lifespan. Okay, so this is a very important aspect. Fourth is globalization. Now, back in the day, US was gaining the power and it was globalizing everything around it. And anyone who invested in US denominated assets, let's say somewhere in like 1960, 1970, they made crazy wealth. One key example here is that, for example, your uncles, aunts might have gone to the US to work, right? Maybe in 80s, 90s. They would have made crazy wealth in the last 40 years. Why? Because they kind of invested in US denominated assets. So now one could argue that, hey, is the world globalizing or deglobalizing? I would say that it is kind of deglobalizing, because the world had globalized quite extensively in the last 40, 50 odd years since the 1970s, with the formation of the new economic world order, WTO, all these different international forums. The world globalized, right? Now we are looking at the peak of this globalization. Will the world deglobalize now? The short answer is probably no, but it will not globalize more. Okay, and who would be globalizing it now or taking the reins forward? Maybe a split of China and the US. So from an economics point of view, does it make sense to invest in the US now? Yes. Does it make sense to invest in China right now? Yes. Does it make sense to invest in the Middle East right now? Yes. Okay. Any good economy, regional economies that you see, it kind of makes sense to invest. Does it make sense to invest in India right now? Yes, right, little bit money. But if you are having all your investments in one bucket, it's really bad. Okay, so please don't do that. This is very, very important. Understand the fact that we are at the peak of globalization. Sphere of different regional influences will be made if you're 100% invested in one geography. For example, India, that your job is also there, all your investments is also there. And if India is unable to attach itself to one of the growing superpowers, right? Or for example, right now, India is betting on the US. But if for some reason US declines, India is going to take massive hit along with it. So I see right now, as we speak, as I'm making this video, right now, India is aligned with the US. Why? Because India cannot manufacture like China. India is not a satellite state of China like Vietnam, Cambodia, etc. So India is picking a side, and India has picked a side of US, right? Very similar to how India picked in Cold War I, Russia's side, right? So similarly, right now we are picking US's side. You have to consider India as a hedge if you're an investor, which brings me to the final point of the video. So what are some of the key points that you should remember as an investor? And here are some critical points that you should know. Number one, the US inflation or US domestic inflation is going to go up. This is not even up for debate. I'm not even saying it as a possibility. This will 100% happen. Now, yes, government can always manage the number, right? That they will say that, okay, inflation is only 3%, 4%, whatever it is. But in reality, the cost of living is going to go crazy. So please own a real estate, right? That's my first piece of advice. This is something that I have been saying for the last 3-4 years now. I myself picked most of my real estate between the year 2022 and 2024, right? That is where I invested crazy amount of money. Before 2022, I used to be 100% equity guy. Now I am like almost 60-65% of my portfolio is equity, rest is real estate plus cryptocurrencies. So that is where I am investing. Second key point is that as the inflation in the US goes up, inflation means cost of living goes up, it will impact everyone, even back people in India. Now, how do I know this? It's very simple, that US is able to export inflation to the world. And here's a video that I've done on that topic, that if something happens to inflation in the US, they always have the option of printing more money, taking more debt, figuring out their low problems. Now, because of the fact that most of the world deals in the US dollar for trade, almost 60-70% dominance of world trade is dictated by the US dollar. What happens is very simple, that US is able to export those US dollars to the world, right? Even to countries like India, and we also face inflation. So is India going to face inflation? Yes. So please brace for it. This will impact your retirement plans. So you need to have a sense as to how to build your portfolio, all this stuff. I do teach courses. I've spoken about it earlier. In case you guys are interested, you can sign up. I only offer limited seats, right? My Dubai workshop is done, and the next key course that I'll be launching will be a live stock market course. So in case you are interested, you can sign up for that. Third key point is that China might sell less. Why? Because US has understood the point that China is going to aggregate a lot of US dollar or US treasuries, and because of the fact that US is a net importer of goods of China, it is sending a lot of money to China, and China can destabilize its economy in simple terms. There are two examples around it, that recently the Chinese sold a lot of US treasuries, they sold a lot of US dollars. Okay, so as a result, US got spooked and they came out full throttle that, hey, you know what, other countries, we are still going to trade, but with China, more tariffs for you. So these are bullying tactics. I don't know till what point this will continue, but to cut the long story short, US giving more power to China happens if US starts importing more and more stuff. Now US has also started to realize, so US is going to undertake some manufacturing capabilities. So investing some money maybe in US small caps kind of makes sense. Now I also run a US stock specific community that I've spoken about, so you could consider joining that as well. I write very detailed macro notes which will help you make investment decisions. So the next point is around US's global superpower. Now, for example, if you look at McDonald's, Starbucks, all are US based companies, people enjoy engaging with these brands. Now, if you look at China, for example, Luckin Coffee and whatever is coming up, they are also playing exactly the soft power game. Now, the sphere of dominance of China is going to grow. So therefore, it makes sense to build some positions even in Chinese market. Now, as international investors, we would typically not buy like Chinese real estate market. So what is it that we could potentially buy? So Chinese based equities is what we can potentially look at. So I am also studying more, and I will keep on informing you guys regarding the same. Next comes the point that, hey, in the short term, what is going to happen? Is this going to cause a crash that China and US are fighting, all that stuff? There are rounds of counter tariffs. No, it will keep the market very volatile, right? And we are already exhibiting that, right? For example, the markets fell very much in the US, then they rose by 11% in a single day. All those things are happening. So understanding that you need to trade volatility is critical. Now, this is something again that I teach on my courses on how to do. I run a community around it. People have benefited a lot. So my advice to you would be that learn how to trade this volatility. This is going to be important. Those days of simply doing SIPs are gone. It will not work anymore. I have been quite consistent with my approach on this, and I have been stating this quite explicitly, and I still maintain this viewpoint. Next and final point comes that you should have investments across different asset classes, and that asset class should serve some purpose for you. For example, many people want to make regular income from the stock market. It doesn't make sense anymore because in a highly volatile stock market, you will not be able to make regular income. It's impossible to do, okay, unless you are extremely lucky. To make regular income, you have to buy cash flow real estate properties. Now, what is the meaning of cash flow real estate properties? For example, you buy a house worth or a property worth 1 crore and you are getting a rent of 5 lakhs. That's 5% cash flow, right? Now, these type of properties are very difficult to find in majority of India. I have a lot of investments like these in Goa. I'm buying more in Dubai. I have been able to find this. So you will be able to find this if you expand your viewpoint. If your point is, yeah, you know what, I live in Hyderabad, I'll find real estate in Hyderabad only, then nahi hoga wo, right? I mean, you have to have like little bit of common sense and invest across asset classes. Now, many people keep on arguing with me that, the stock market grows at like 12%, 13% CAGR, but real estate market grows up like 2%, 3%. See, I have no interest in arguing with you. Do whatever you like. It's your money, okay? Common sense tells us that if you are getting definite income from, let's say, real estate, what it allows you to do is that it allows you to buy dips. For example, the US stock market last week corrected by at least 10-15%. Now, that allows you to buy a dip if you have a certain cash flow. You can probably even take a line of credit and invest. Now, this is not an advice that you should do that, but if you are getting definite cash flows from real estate, this is a possibility that opens up, right? So I'll just leave the conversation there, otherwise it will become very big. So to cut the long story short, very simple, that this is not Cold War 2.0. This situation will get resolved. This is a buffalo-egret relationship that US and China have. Short term, mid term, I don't think anything massive is going to happen except for stock market, bond market volatility, which we are already seeing. And a sensible investor needs to invest across geographies and across asset classes. This is exactly what I'm doing and exactly teaching my students to do. Thank you so much for watching this video, and I'll see you soon.